Welcome to podcast for topic F. We're back at Mystic Herbals, a problem we dealt with in an earlier podcast D. And this time we are going to talk about the actual allocation of the joint costs per batch of zubonic root. And in problem 8.4, with this topic we're talking about how gap allocations are made, because we are trying to determine what the full cost of an ordinary product is for pricing purposes. And some of the problems deal with cost plus contracts. In this particular case, we'll see what happens to the cost of the 4 joint products after the joint cost of $30,000 is allocated as GAAP requires. Now remember that this allocation is not made for economic viability decisions. This allocation is made for pricing purposes, so that costs are marked up and the price algorithm is applied to that cost. That's known as full cost, and that is the cost that will appear in inventory for any excess products left over that are unsold. So these are costs according to GAAP, which allows a number of different allocation methods for joint products, none of which are any better than another for making viability decisions, as we'll see in the last case. So, starting with problem 8.4, parts A and C, let's talk about what happens when we allocate first the cost of the $30,000 joint cost to each of the joint products based on the number of ounces. Now, if we allocate, the allocation for the joint costs is $60 per ounce. You take the total joint cost divided by the total number of ounces produced, which is 500. So the highest allocation in that case goes to LZ9. It's 11,700. One of the zeros seems to have escaped to the bottom line. The lowest allocation goes to VX7. Now let's take a look at part D, where the allocation is using a net realizable value. Now, net realizable value in the case of QV3, 7, VX7, HM4, and LZ9 mean that HM4 gets the highest allocation at 40.65% of the net realizable value. You get an allocated joint cost of a little over $12,000, and the net income per batch for this product is 1,179. It is carrying most of the joint cost allocation, although the joint costs would continue to be accrued whether this product was produced or not. So total accounting income of $2,900 per batch. Now let's take a look at 8.5. Now in 8.5, we have a bank, Fidelity Bank, that has 5 service departments, of which information management and telecom are 2, and also 3 lines of business, the retail banking, the commercial banking, credit card. And the purpose of the cost allocation done at Fidelity Bank is to allocate the costs of the service departments to their ultimate lines of business. Now, in the first case, part A, Fidelity Bank has decided to use the step-down method. The order is specified in the table in the problem. You can see the order by taking a look at which service department is zeroed out first. In case they are actually listed in the order of allocation: telecom, information management, building occupancy, training, and development, and human resources are allocated sequentially as they're listed. As you can see from the the indications that they've been zeroed out all across the board in sequential order. Now, telecoms is allocated first. Now, 15% of the telecom income goes to information management. You can see that by looking across the row that contains telecom to the third column, which is information management, and you'll see that 15% of the allocation of the telecom services goes to information management. Therefore, before allocating information management, which is what we're required to do in Part A, we must first pick up the additional costs from telecom's direct operating expenses. So again, 15% of the shares of telecom services go to information management, which is $525,000. So that increases the total information management cost to be allocated to $10,325,000. Credit card then picks up a proportion of its shares. Now, its costs. Now, in information management, credit cards are picking up %15, but we have to remember that telecom has dropped out of the picture entirely. So, and so will information management. So the total that information management provides is 5% of its services to building, 10% to human resources, 10% to training and development, 20 to retail banking, 20 to commercial banking, and 15 to credit card. Now the 15 to credit card, of course, that doesn't add up to 100 because we no longer allocate services to telecom, and we don't, and so telecom drops out. So there's only 80% of the services, if you add the row across, that are being allocated. The denominator is now 80%. 15 out of 80, or 18.75, goes to credit card. So the credit card share of IM is $10,325,000. IM plus its proportion of the telecom costs times 18.75. So we have an allocation of, using the step-down method, of $1.935 million. In Part C, it asks us to do a direct allocation. Now, in a direct allocation, if you take a look at information management, the denominator for the purposes of allocation is 20 plus 20 plus 15, or 50. 15 out of 50 percent, or 27.27, goes to credit cards. And remembering that under direct allocation, the information management services are not allocated to any other service department. Now this leads to an allocated IM cost for credit cards of $2.7 million, almost $2.67, which is 27.27% times $9.8 million, which is the original cost of information management. It picks up no other costs from other service departments either. So that's the complete allocation, and you see that it differs quite dramatically depending on the allocation method selected. So the allocation then is can be done a number of different ways. So let's talk then about the shipbuilding industry. Now, in the shipbuilding industry, this is a cost-plus problem. And in the shipbuilding industry, this BFR that builds ships has a cost-plus contract with the Coast Guard to supply the ships that are used to track down and find illegal drug smugglers. Now, the costs then for a cost plus product contract are direct materials, direct labor, purchased subassemblies, engines, radios, etc., and overhead. Now, overhead is allocated to the Coast Guard contract based on the ratio of direct labor expense on the contract to the firm-wide direct labor. Now, they have a choice. BFR can either purchase the engines from an outside source or build them internally. And they have an overhead. The overhead's not going to change because it's primarily consisting of corporate level salaries, building depreciation, property taxes, etc. So the overhead for BFR is $83.5 million, and it will not vary whether the engines are purchased outside or not. So the first question in Part A is how much overhead is allocated to the Coast Guard contract if, number one, the engines are manufactured internally, or number two, they're purchased outside. Now, using the following table, we can calculate the amount of overhead allocated to the Coast Guard contract depending on whether the engines are manufactured by BFR, purchased by an external, purchased from an external vendor. The direct labor will differ, and the allocation then will differ according to the fact that the direct labor the firm-wide direct labor has shifted. So the Coast Guard's then for contract for engines manufactured internally will result in an allocated overhead to the contract of $50,930,000. For external purchase, the amount of overhead allocated to the Coast Guard contract, because the direct labor has reduced, is about $46 million, or 45.92. So it is going to make a difference because the contract price for the Coast Guard under the two scenarios ranges from $111,967 with the highest allocation to $112,237 by purchasing it externally, because the cost of the purchased engines are more than the costs to manufacture. We have a total of slightly more for the contracts purchased externally, even though the overhead allocation is less. Now the net cash flow to BFR of internal versus external sourcing of the engines indicates that the net cash flow is higher if they're manufactured internally than if they're purchased externally for BFR. So BFR generates an additional $4.9 million of cash flow by manufacturing the engines internally, and the reason is that the internal sourcing raises the overhead allocation percentage from 55 to 61%. Since this overhead doesn't vary with the sourcing decision, BFR is able to recover more of its fixed costs from the government by increasing the amount of direct labor chargeable to the government. And this shouldn't be an issue with the government because it actually gets a lower cost overall for the contract. Now, will cost-plus contracts encourage contractors to make or buy? Given that the defense contractors have fixed overhead that is allocable to cost-plus contracts, and the allocation is often based on direct labor, any decision that causes the contractor to consume more direct labor on the government contract increases the amount of overhead chargeable to the government. The make-buy decision is one that involves the contractor using internal labor versus external labor. Therefore, cost-plus contracts will encourage contractors to make rather than to buy. The make-buy decision is not the only internal decision affected by cost-plus contracts. The decision to substitute capital for labor is also affected by the contracts. Defense contracts will shun capital in favor of labor to boost the amount of overhead allocated to the government contracts, using direct labor as the allocation base. And researchers have actually found that defense contractors employ less automation, which is highly capital intensive, and have more internal sourcing than is optimal. So the next problem we're going to look at is actually a case, case 7-2, and this is a chemical company that makes $2 billion. It is a plastic plant, and it's trying to decide whether it should shut down the plastic plant or not. And they have a number of alternate uses for the plastic plant. First of all, they want there's an opportunity to use the auto industry, the plant's excess capacity, to produce high-strength plastic used by the auto industry. And they've got a lot of new equipment they're going to use. And the question is this auto industry opportunity a profitable one? And it turns out that they're saving about $2 million. They add back depreciation, and the net cash outflow saved is about $2 million. The only if we produce the film plastic, we're going to have a net cash outflow of $2 million, and if you take a look at the performance report of the film and the automobile divisions, we can see that there's something a little bit odd in the relative performance. Now, looking at the performance reports, you'll note that something indeed seems odd, because the film was losing $7 million before adding the auto. Now film appears 7 times more profitable than auto. The performance report in B appears to be distorting our understanding of the facts of the situation. So let's go back and take a more careful look at this report, specifically looking at what's happening to the allocated common costs. And in this case, the allocated common costs are being picked up by or split between auto and film. And since the auto is picking up 9.6 million roughly of the allocated common costs, which would exist anyway, all of a sudden the film industry, the film production, is looking very profitable indeed. But that's, again, just a distortion caused by the allocated common costs. And if you were going to make a decision about which division to drop or keep, you would not use these numbers. So that just reinforces the fact that this gap costing may be useful for reporting segment income on the income statement, but is not useful for making viability decisions, because it produces distortion in people's understanding of the facts of the situation. So that ends podcast F. I hope this has enhanced your understanding of this topic, And the next podcast will be podcast for topic H.